Stop right now. Don't you dare follow another eToro copy trader. Your money is truly at stake and not in a good way. eToro copy trading is actually everything wrong with modern day investing. On the outside, it's high returns and it's completely passive. So much excitement for so little effort. It is very much the new age of active fund management. Don't people learn anything? If you have no idea what I'm on about, then I'll explain shortly. But first, let me throw over to David, who I'm collaborating with on this video.
Hi folks, I'm David from prettypenny.club. I make videos to help you reach your financial goals with content on investing, passive income, frugal living, generally trying to make your money work harder for you. So once you're done with Nick's video and after you have ruined his like button, make sure you jump over to my channel to hear what I have to say about copy trading. Thanks very much.
Thanks, David. Anyway, you can tell eToro's copy trading is incredibly successful. It's popular in word search on Google, but you can also see it on YouTube. Videos looking at returns over several months of eToro copy trading are getting 50,000 views. On top of this, eToro runs the vast majority of its campaigns with copy trading at the front and centre. I actually wouldn't be too surprised if you got an eToro advert on this video. Remember that guy who was working on being a high-level wizard or something, but then also getting great market gains?
Dave does research on how to become a level 60 wizard.
Yeah, what a weird but also great advert. It is eToro's point of difference, so I completely get it. It's a very good business move on their side. But here's why I believe you should avoid copy trading like the plague. Well, that turn of phrase doesn't age well, has it? So I'm going to have to find another one. Anyway, the premise of copy trading is extremely simple. You designate some, if not all of your funds to sync with the buy and sell orders of another trader. So it's your money in the hands of another person. They're professionals after all, so your money couldn't be in better hands, right? After all, most of us don't build extensions ourselves, we get a builder to do it. And God forbid, we don't teach our own kids maths, we get a maths teacher to do it. So surely, we don't grow our own money, a fund manager does. Well, fund managers have been around for a very, very long time, and for obvious reason. We pay a professional a very small percentage of our money, so they can actually invest the money for us to grow it as much as possible. This means that somebody is working day and night for a very, very low cost to find the best places to put your money, but then also avoid the bad places to put your money also to stop you losing value. This means they can grow your money a lot better than you could. After all, do you want to fly the plane yourself or do you want a pilot to do it? I know who I'd want in the cockpit. Active fund managers have been around since the 1930s, so they really are a staple of our financial sector when it comes to investing. But we have one slight problem. It doesn't work. Luckily for you and me, we now have data of nearly 90 years worth of active hedge fund manager performance, so we can actually look at what they're delivering for their money. This isn't to say that some active managers don't get favourable returns, but consistent overperformance is virtually non-existent. Before I hear someone yell from the backseat, the Oracle of Omaha, I'll get round to him in 1 minute, just be patient. So what does the data say? Well, SPIVA, which stands for the S&P Indices versus Active Funds, scorecard active fund managers against their relevant indexes. The data shows the following, that the most, and I must emphasise the word most, active equity managers underperform against basic indexes most of the time. Their latest findings remain consistent with all the findings that go all the way back to 2002. And this data shows that 69.33% of all active fund managers fail to beat the stock market average. So that's nearly 7 in 10. And these figures have no sign of getting better anytime soon. The author of this research summarised the results fairly well by saying, the most important thing to realise about the results is that they are not a coincidence. The active management community didn't lose a cosmic coin toss 90 years in a row. Active underperformance happens for a set of readily identifiable reasons. The author goes on to set out 4 clear reasons of why this happens, which come under 4 subheadings. You've got professionalism, standing out, long-term success requires short-term underperformance, and the long-term. The first of these factors is how much the industry has changed over the last 90 years. Back in the 1940s, when I can only imagine they were probably riding dinosaurs, there was only a very small amount of money managed by professionals, roughly 10%. The remaining 9% were managed by retail investors who would typically buy and sell stocks without any data or any insight. This means it was easy for professionals to spot a great deal when they could see one and take advantage. So active fund managers did have their day at some point. But a lot has changed since then. Since this point, 99% of trading is done by institutional investors, meaning that nearly every time someone buys or sells, then it's either to or from a professional, meaning there's very little room or actually no room to take advantage. Traders are getting better and better, which is making it increasingly difficult to find outperformance of the market, which is commonly referred to as alpha. The next point is standing out. Active fund managers don't struggle because they're bad at what they do. They actually struggle because they're all very good at what they do. Managing a portfolio of stocks and shares is a zero-sum game, meaning that somebody's outperformance or alpha is actually somebody else's loss. The average professional can't beat the market because the average professional is the market. It's extremely hard to have any kind of advantage when everyone has access to the same information, the same skills, and the same abilities to trade. So it's not really that surprising that not many fund managers stand out. The next subheading was long-term success requires short-term underperformance, but I see this better titled as being risk-adverse. It's been widely identified that long-term horizons are needed to be successful and relies on a lot of patience which most professionals and their key stakeholders don't possess. Let me give you an example. If you'd invested £1,000 into Apple shortly before the bursting of the dot-com bubble, then your position would have fallen to £275. But if you'd held that position till today, it would have grown to £155,000. Probably one of the best returns you would have got out of any stock in the market. The problem you have here is that fund managers picking one of the best stocks of a lifetime would have surely got fired if they'd lost 75% of their clients' money overnight. If they didn't lose their jobs, then would have definitely lost clients along the way. Does this sound familiar to eToro traders? Are you picking the ones who historically have a good performance and you're actually overlooking the ones who might have found the apples of the world just after the dot-com bubble bursting? It's just a thought. And the last reason is long-term, which I think is really interesting. Morningstar looked at firms which were long-term outperformers, so we're not even looking at 30% which can beat the benchmarks over a short term. We're looking at the top 0.1%, which means they're beating the benchmark over a 15-year period. They found that during that period, these companies actually underperformed against their benchmark 75% of the time. So even if you're looking right at a long-term winner, you might not easily notice they're going to be the winners, as they're most likely underperforming most of the time. What I'm trying to say here is, welcome to the fallacy of stock picking, where you might feel like you have more control, but actually any intuition or feeling is good for pretty much nothing. Or actually, it's good for losing your money versus the average market performance. There will always be a hedge fund manager which is flavour of the month. Cathy Wood is up there at the moment, especially with the picks on Tesla. But then think back to the early 2000s with Neil Woodward. After smashing the market with a 25x over a 26-year period, he then actually moved to create his very own fund, which then proceeded to lose 67% of his clients' money in a little over 2.5 years. That's survivorship bias for you. Okay, I'll get round to it. How has Warren Buffett done this over such a sustained period of time? Very good question, and I'm glad you asked. Warren has been really smart. He's turned his short-term success in performance into a sustainable advantage over the market. He's at the point where he can broker his very own deals, which you and I don't have access to. He is no longer playing the game of picking out the winners in the market. He's competing at a table that we can't even get a seat at. But in my opinion, eToro copy trading is worse. There might not be any management fees, but there are trading fees. So every time your trader of choice buys or sells a position, you're getting charged that fee every single time. No wonder eToro love it. On top of this, there is a significant lack of accountability here. A lot of these traders haven't got a company they stand behind. They're just armchair traders. They don't have a brand or business that they need to protect. Due to this, they don't play by any sort of regulation, meaning there's no real sort of safety net for you. Isn't that a slight concern? But even after all this research and all the issues I highlight, I need to make one thing clear. I have no problem with stock picking, or actually eToro for that matter, and I need to tell you why. It's for the simple fact that picking stocks is a lot of fun. Let's be honest, investing into low cost and well diversified ETFs is boring. Seeing your account balance swing by 1.5% this way or that way is not that exciting, but in the world of picking stocks, the volatility you see is gains of 15% and losses of 15%. It's truly a wild ride. No wonder people like it. But if you agree with this, then surely it validates my point even more. Why are you giving this joy to somebody else? Surely you want to drive the car around the track, not somewhere else. Unreal gains feel much better when it's your own intuition and not somebody else's. If you're getting into eToro copy trading to beat the market, then please reconsider. I am not a financial advisor, so nothing I say is financial advice, but for God's sake, go read a book or at least some articles. For me, stock picking is even less worthwhile if you're getting somebody else to do it for you. I'm actually really passionate about the stock picking topic, but sadly I sit on the wrong side of the fence compared to what's popular on YouTube. I don't believe you can beat the market by stock picking, plain and simple. But saying that, I completely see the fun and challenge behind it. And for this reason, I've actually been toying around with an idea for a while of a way to prove that stock picking is fruitless by stock picking. The idea has gone through a lot of different versions, but I think I might have finally cracked it. I'm going to allocate a little bit of money to two different accounts, one being free trade and the other one being eToro. I'm going to do stock picking, but with a twist. I'm going to benchmark my results against my dog, who will obviously be picking stocks at random. Keep an eye out for my first episode, which might be coming out a little bit sooner than you might think. Anyway, I hope you've enjoyed this video on my thoughts around eToro's copy trading function. As said at the start of the video, please go and check out David's video as he has a completely different take to what I do. I'll make sure I put a link at the very top of the description. Anyway, that's all for this video. See you in the next one.